Hi, welcome back to the channel. Since you're watching this video, I'm going to assume that you're somewhat familiar with what a stock being classified as deep value entails. I'm assuming that we both agree that value investing is quite simply finding value and capitalizing on mispriced securities. Your goal and mine is to benefit from this mispricing in order to achieve a high rate of return with low risk, something that goes against what a lot of the market preaches, which is high risk and high return. I'm going to explain to you the underlying ideology behind my approach, which I like to call intermediate deep value investing. So let's get into it. Let's start off with Ramdev Agarwal, a well-known Indian investor. He has stated that there are three dimensions to value: value in the mind of the buyer, value in the mind of the seller, and the true intrinsic value. Buyers buy a stock because they presume there to be more value than what the current market capitalization encompasses. We sell a stock because we think it's not going to give us an adequate rate of return moving forward. The true value of a company lies somewhere between the perceptions of the buyers and the sellers. Now the question is, how do we find the stocks with the least discrepancy between the price that someone is willing to sell at and the value that we are willing to buy at? We need cheap stocks and we need them with a margin of safety, right? The reason stock prices become too cheap or too expensive is largely due to irrationality. It's irrational exuberance or depression. Charlie Munger always suggests that it's a good idea to invert the problem. So if the path to becoming wealthy in the stock market is through rationality, inverting the problem means to figure out what the driver behind irrationality in the stock market is. So how exactly do we benefit from this emotional irrationality? That is the question. I want you to watch a short clip from Joel Greenblatt just so you're able to break down the logic behind the thought process before we really start breaking down the approach.
You know, once a year in my class at Columbia, at least for the last 5-6 years, somebody raises their hand and asked a question that goes something along the lines, something like this: hey, Joel, congratulations, you've been doing this for 35 years, and you've had a nice record, but now there are more computers, there's more data, there's more ability to crunch numbers, and kind of isn't the party over for us? Isn't it just more hedge funds? There's just a lot more competition. Isn't the party over for us? So my students are generally second-year MBAs, I'd say average age 27 or so. So I just answer it this way. I tell them, let's go back to when you learned how to read. Let's take a look at the most followed market in the world. That would be the United States. Let's take a look at the most followed stocks within the most followed market in the world. Those would be the S&P 500 stocks. Let's take a look at what's happened since you learned how to read. So I tell them from 1997, when they were 9 or 10, to 2000, the S&P 500 doubled. From 2000 to 2002, it halved. From 2002 to 2007, it doubled. From 2007 to 2009, it halved. And from 2009 to today, it's roughly tripled, which is my way of telling them that people are still crazy. That was just the last 17 years. And I'm way understating the case because the S&P 500 is an average of 500 stocks. If you lift up the covers and look underneath what's going on, there's huge dispersion of those 500 stocks between those at any particular time that are in favor and those that are out of favor. And so there's a wild ride going underneath the covers. If you look under the covers, there's a wild ride of those 500 stocks at any particular time. And that doubling and halving with the average of 500 stocks is really smoothing the ride. So there should be an opportunity. And if you understand what stocks are, and I guarantee my students' first day of class, I make a guarantee every year they walk in, and I guarantee them this: if they do good valuation work of a company, I guarantee them the market will agree with them. I just never tell them when. Could be a couple weeks, could be 2 or 3 years, but if they do good valuation work, the market will agree with them. Stocks are not pieces of paper that bounce up and down, and you put complicated ratios on, like Sharpe ratios or Sortino ratios. Stocks are ownership shares of businesses that you are valuing, and if so inclined, try to buy at a discount. So if you believe what Ben Graham said, that this horizontal line is fair value, and this wavy line around that horizontal line are stock prices, and you have a disciplined process to buy perhaps more than your fair share when they're below the line, and if so inclined, sell or short more than your fair share when they're above the line, the market is throwing us pitches all of the time. The reason people don't outperform the market, there are behavioral problems, there are agency problems, but it's not because we're not getting those opportunities.
Now, we've all learned from Graham that in the short term, the market is a voting machine. In the long term, it's a weighing machine. Well, what about the intermediate term? Is there a way to exploit the irrationality of the voting machine while benefiting from the weighing machine? I looked for commonality between stocks that perform the best within this intermediate term and found that there is one beautifully consistent theme: short interest. Short interest is irrational exuberance inverted. When someone decides to short a stock, not only do they think that the stock is not going to get a good return in the future, they believe that the stock price is going to be significantly lower. The best scenario for someone who is a short seller is that the stock goes to zero. The company basically just goes bankrupt. Look for the companies with the highest short interest if you're interested to find the cheapest stocks in the market, because not only are apparently bad fundamentals priced in, but the key factor of irrationality, which is market sentiment, is also heavily discounting the future prospects of this company. It is very difficult for a company to go bankrupt if it has more cash than debt and if it has a major catalyst that's coming up in the intermediate term. This was my thought when I was looking at GameStop, which is number one on this list, by the way. If you are someone who tracks value investors, your eyes are going to light up when you see this list. Here we have GameStop, Bed Bath & Beyond, Michael's company, names we've seen in Michael Burry's portfolio. There are also companies such as Nordstrom, Heritage Growth Properties, which may sound familiar if, again, you track value investors. I'm not saying that these companies are good companies to buy. I'm saying that these are companies that market participants want to see go down. This is where contrarian thinking is really rewarded. What I like to do is go through this list and pick out the companies that I think are within my own circle of competence. Then I just read about them and figure out what makes sense to me, what seems like value in my perception, and then I just go for it. If something is worth 50, but it's sitting at 5, that is where you, as a contrarian value investor, will be able to earn your return. In aggregate, if someone was to make like an equal weighted portfolio of the top 25 of these stocks that you see in the short interest, the person would have earned around 43% in 2020. This is with a blindly picked, equally weighted portfolio accounting for all the winners and the losers, including the March dip that we had this year. If the person happened to make the same portfolio during the dip, then the returns would be in excess of 140%, with a win rate of 80%. Now, if you're a beginner, don't just get impressed by the numbers here. Run the numbers by yourself, because there are many ways that you can actually improve this return. This list should serve as a hunting ground. Figure out whatever is in your circle of competence and take a nice big swing when you see an opportunity. You just need maybe 2 or 3 of these to do extremely well for the rest of the year, maybe in a few years actually. When I first got into GameStop, it was in the $4 to $5 range. I could actually just visualize the company being a 3x by the end of the year. You know, there are scenarios where I actually kind of see the company hitting maybe $40 per share by mid-2021. I'm only able to hold with conviction because it is in my circle of competence and I'm constantly reevaluating the probabilities of future outcomes. This is just one of the frameworks that I use to find stocks to buy into. Your strategy has to be dynamic based on the type of portfolio that you're managing. Value investing is timeless, but you have to be dynamic within that realm because all of value is perception. You need to have strong beliefs, but held loosely. Now, I'm speaking from experience here. Doing that extra bit of work is worth it if you want to compound at anything above 25% annually. Even if you're wrong on, say, 1 out of 4 companies, you're still going to have numbers that will alter your personal monetary net worth in a decade. Also, one key piece of advice that I would give is that set a minimum holding period if the price action is in your favor. It ties back to the quote at the beginning of the video: selling your winners and holding your losers is like cutting the flowers and watering the weeds. What I'm trying to say is that this approach requires patience. If you were wrong in your analysis and the price is telling you that you were wrong, revisit your analysis to find holes in your judgment. And if there aren't any holes that you can find, then hold it with conviction. It is an absolute requirement to be fallible in order to succeed when investing. Now, if you were able to find the winners within this strategy, well, then your problem is to figure out how to take profits, which is a good problem to have. Enjoy the beauty of the flowers, but remember that flowers don't last long, no matter how monetarily or emotionally invested you are in the company. The stock doesn't know that you've bought it. If you've done your analysis correctly, you should have already figured out when and how to exit before getting in. Now, if you watched the video all the way till the end, let me know what you think about this approach of intermediate deep value investing. There is a lot that you could do to improve and adapt this approach for yourself. I'm kind of just presenting this to you as a base that I like to use. Do share with me how you would adapt this for yourself, and it might even be something that helps me out fine-tune my own approach. So yeah, hope that you like this video, and thank you for watching.